Imagine a mighty river carving its path through a vast landscape. Its flow, at times smooth and serene, can also face turbulent rapids threatening its course. In many ways, this mirrors the journey of Petro Rabigh, a leading petrochemical company navigating the volatile tides of the global market. Like rocks beneath the surface, disrupting a river's flow, operational inefficiencies and macroeconomic challenges have significantly impacted the company, as seen in its accumulated losses amount to Saudi riyal 6.41 billion, representing 38.34 of the company's capital on 2023. This is due to challenging market conditions that had an adverse impact of margins on their product. This study explores the current of an internal efficiency and external economic forces that shape Petrorabics ROE. So, to understand this, my research aims to identify the internal and external factors driving the performance with the questions like what internal strategies keep the flow steady and how do internal external forces shape the reverse course and how both these factors together affect the This study focuses on understanding Petrorabics ROE by analyzing internal and external factors. Internal drivers like return on asset and operational efficiency have a strong positive impact on profitability, as noted by Tekin on 2022 and Al Sulami on 2024. Externally, macroeconomic variables such as inflation and interest rates significantly influence ROE. For example, Rayleigh on 1997 highlighted a positive correlation between inflation and equity returns, while Su on 2099 emphasized the risk from economic instability and geopolitical tensions. These findings guided our study to assess how internal variables like ROA and liquidity, combined with external elements like inflation and GDP, shape the Petrorabics financial performance. The sample comprises Petrorabic's annual report from 2013 to 2023, analyzed using SPSS version 29. I employed the ordinary least square OLS regression method to assess the relationship between variables. Three models were developed. The Model 1 examines internal factors like ROA, current ratio, and operational ratios. Model 2 focuses on external variables including inflation and GDP. Model 3 combines both internal and external factors to evaluate their collective impact on ROE. Now, let's analyze the findings. Descriptive statistics. This involves analyzing the central tendencies and variability for variables in Model 3, such as ROA, current ratio, inflation, and ROE. These stats reveal performance trends and variability across 2013 to 2023. The data range. ROE might show a volatility due to market fluctuations, while ROA could indicate the company's operational consistency. Statistics revealed a mean ROE of 16.71%, but with high variability indicating volatile profitability. In Model 3, the correlation between ROE and ROA could be the strongest, as ROA typically reflects asset efficiency in generating returns. Mention a non-significant variable like GDP, which might show a weak or negligible correlation with ROE, highlighting its limited turbulence. The ANOVA result confirms the model's overall significance with a p-value of less than 0.05. This indicates that the predictors collectively explain a significant portion of ROE's variance. Model summary, on the other hand, the adjusted R squared for the Model 3 might be around 0.984, demonstrating the model explains nearly 98.4% of the variation in ROE. This high value highlights the robustness of Model 3 compared to the other models, confirming its predictive power. In regression coefficient, ROA likely has the most significant positive impact on ROE, as its coefficient might show a high value and statistical significance. For example, a 1% increase in ROA could lead to a 5% rise in ROE, emphasizing operational efficiency's role in profitability. This aligns with studies suggesting the asset utilization is crucial in boosting shareholders' return. Conversely, non-significant variables like FDI, foreign direct investment, might show weak or negligible effects. In summary, the Model 1 internal factors ROA had the strongest positive impact on ROE, highlighting the importance of efficient asset utilization. Liquidity measures like current ratio showed a weak, insignificant effects on probability. The implication is that companies should prioritize asset optimization over short-term liquidity to boost ROE. In Model 2, the external factors, the inflation rate, significantly boosted ROE, while the current account balance negatively impacted profitability due to trade deficits. It means the companies can leverage inflation-driven revenue growth but need strategies to mitigate macroeconomic risk. Combined factors in Model 3, where the ROA remained the top predictor with the inflation rate also contributing positively, the model's high adjusted R squared 0.984 revealed that the strong collective impact of internal and external factors on ROE, which means the companies must enhance internal efficiency while adapting to external economic conditions for improved performance. In conclusion, Petro Rabigh's financial journey is much like a river navigating a dynamic and unpredictable terrain. The steady flow of internal strengths such as ROA has proven to be the key driver of its profitability. However, external forces like inflation and market volatility often create rapids, disrupting the company's smooth progress. To chart a clearer course, I recommend strengthening operational efficiency, much like reinforcing the riverbanks to prevent erosion. Enhancing liquidity management would act as reservoirs, ensuring the company has the resources to weather the financial droughts. Furthermore, diversifying revenue streams and adopting the robust risk management strategies would serve as a dam controlling the flow and minimizing the impact of external disruptions. By implementing these measures, Petro Rabigh can not only navigate the turbulent waters ahead, but also carve a path toward sustainable growth and profitability.